Ken, this wouldn't normally be an event that would impact high yield. We saw a major volatility event yesterday, the VIX back to levels that we last saw during the China currency crisis, and perhaps even, not even that far away from where it was in the middle of the housing crisis way back in 2008. How did it impact the high yield market, if at all?
Well, Vonnie, this is almost kind of a reverse of what we saw in November of last year. You may recall in November the high yield market spiked in terms of spreads, and there was concern as to whether or not that was signaling some sort of contagion that was eventually going to bleed into the S&P 500.
At the end of the segment.
And eventually what we saw a rally back, and spreads kind of tightened in fairly dramatically. This time around, we've seen a spike, obviously, in volatility in equities in particular, but we have not seen any follow-on move in the high-yield marketplace. High-yield market is kind of break-even at this point for the year to date. It's certainly lost a bit of money in the last week or so, but it's not been nearly as dramatic.
Now, does that say to you that this event was not really about the Federal Reserve at all? A lot of people are sort of maybe conflating cause and effect or mixing them up a little bit and, putting their interpretation on yesterday's events. And one of those interpretations is that the Fed is moving, easy money era is over, Jerome Powell is now at the head of the Fed and the market is reacting. Is that at all what happened yesterday?
I think it's a big piece of what's happened. It's certainly impacting the credit markets, and I think that that's what the credit markets are concerned about longer term. We had mentioned to clients earlier this year that we were more confident about the first half of 2018 than we were the second half, because we were concerned about potential for continued move by the Fed as well as eventually by the ECB. So, I think that those are real concerns.
What are your chief concerns then, Ken? What are the big pinch points for credit markets this year?
Well, I think it still really relates mostly to what the concerns are regarding central bank activity. It's the proverbial question as to whether they're going to take away the punch bowl. Let's recognize that the stimulus that the tax bill has created for the U.S. economy isn't necessarily one that we needed at this point. The economy's been humming along at a pretty good rate. Arguably, this is a good thing for companies, and I think that you'll see in the earnings front. But I think that that's our major concern, really, is what the central banks end up doing.